The Monetary Policy Committee is holding its fifth meeting of 2025 with Governor Olayemi Cardoso set to announce decisions shortly. Since the last meeting, major economies have eased monetary policy amid weaker labor markets and growth concerns, though inflationary pressures persist. And at home, Nigeria's macroeconomic indicators have improved, with headline inflation slowing to 20.12% in August from 21.88% in July, reflecting softer core and food prices alongside relative currency stability. Growth remains resilient, aided by higher oil output and gradual real sector recovery. And these conditions suggest that the MPC may opt for a modest rate cut or hold policy instead to sustain gains actually and attract capital inflow. But I'm not alone on the show. I've got three other people with me. Dumebi Oluwole, lead economist, Steers, who will be joining virtually. And of course, I have right here with me in the studio, Dr. Omobola Adu, macroeconomist, CSL Stockbrokers Limited. Thank you so much for joining me.
Thanks for having me.
All right. And of course, Shego Shopita will also be joining us later on the show. Let me begin with you now. Talk to us. I mean, it's the MPC decision, and we know it's all about monetary policies, parameters, and all of that. So what's your expectation for the parameters, starting with the MPR?
Yeah, so, I mean, if we, like you just rightly mentioned, right, over the last, let's say, 2 months, we've seen macroeconomic conditions sort of move towards a favorable destination, so to say. We've seen things around the exchange rate has appreciated. We've seen relative stability in the currency, external reserves moving in the right direction, as well as inflation. So when you take these factors together, we believe that it won't be surprising if the Monetary Policy Committee decides to just lower interest rates, maybe by about 50 to 100 basis points for the MPR. That's something that the market is probably expecting, and if we see that happen today, it won't be a surprising decision.
All right, so apart from the MPR, the CRR, liquidity ratio, and, some of the things, what are your expectations for those? A hold or?
Yeah, so we think that probably the Monetary Policy Committee could look around adjusting the asymmetric corridor. So from where it currently stands, we've seen that has been held for quite some time. So we believe that heading into this meeting, just to allow market rates and other rates in the market to adjust in line with the possible reduction in the MPR, we should not be surprised also if the Monetary Policy Committee decides to adjust the asymmetric corridor. But regarding the CRR, the liquidity ratio, that in itself might be held at its current level.
All right. I mean, you're talking about 50 to 100 basis points. In my mind, that's a whole lot. I mean, I would have thought a hold or maybe 25 basis points because, look, a lot of persons are saying things like, we've got gains, we know, but we need to sustain these gains. And again, Fed has finally cut rates for the first time, yeah? And so we would expect that we'll also plug into that and, allow the capital flow into Nigeria, enjoy that for a while before we then, begin to ease rates. I understand there is the fear about balancing, growth, or maybe we want to talk about businesses, but even then the GDP numbers, all those things are looking good.
Yes, it's a good question. Well, I think you have to look at it from the perspective of ensuring policy credibility, right? So we've seen that since this new administration, the Cardoso-led administration came into power, they've done a lot to ensure to build credibility in the Central Bank of Nigeria. Along that line, you would expect that they react to things that are happening in the economy. So if you look at where market interests are right now, just the Treasury bills, we know that the one-year Treasury bill has dropped closer to around the 16% levels from where they were around 18%. So if you see that all what they've done probably over the last couple of months, they've been guiding the market towards the possibility of the rate cut. And then also when you look at it from the US perspective, the Fed reducing interest rates. So for a lot of people, the reason why we've been saying, oh, maybe they should hold the interest rates is because they are worried about capital flight. But if you have a situation where the US Fed has also reduced interest rates, it sort of gives you that room for you to then go ahead to reduce your own interest rate a little without triggering significant capital outflows.
All right, Dumebi is right here with me. Dumebi, if you can hear us, I'd like you to comment on that. What do you make of his point? He's talking about, with the Fed, cutting rates, that probably is a signal for us to toe the same path, because if we're looking at capital flight, that risk is probably reduced. Let me get your thoughts on that, Dumebi.
Yeah, I mean, he's not wrong in that sense. I would say right now it's a 50-50 split. There is room to cut rates, of course, cut rates very cautiously. There's also room to still hold for reasons that you had also highlighted, as to the fact that inflation, while down, we're still seeing that there could be shocks, especially from the agricultural sector, where productivity is still an issue, and there has to be room for us to significantly increase production to ensure that we have significant slowdown in prices all year round. So I think I align with the fact that it's a 50-50 split. There wouldn't be anything wrong with a cautious reduction in the MPR right now. There also wouldn't be anything wrong if the MPC decides to also hold, especially when you consider that inflation is relatively down. At least we've seen that decline for 5 consecutive months now. GDP is also rising about 4% for Q2. Interest rates on T-bills are also lower than the MPR now. And we are still seeing that FPI inflows coming. And when you net it off, you will see that we're still kind of in a positive position, so to say, in terms of our real rate of returns, and it would still encourage investors to bring in capital. I think we're still in a good position. If there will be a cut, it will be a very minimal one, and I think that the CBN has shown us that they will definitely continue to err on the side of caution.
Well, talking about inflation, which you mentioned, I'm looking at the fact that when you look at it year on year, you can say core inflation, food inflation, all of that, we're seeing it, go down and all that. But when you look at it month on month, core inflation remains elevated, right? And then, so when you also look at while we're having, that disinflation in food inflation, it's probably seasonal to a large extent. I mean, how many of that is as a result of structural issues being addressed? So in that light, looking at that, or starting on that premise, I want to ask you, do you think the disinflation can be sufficiently sustained?
You're not wrong in the sense that there are still a lot of structural issues, to be addressed. I mean, I did mention the fact that agri productivity is still an issue, but I will definitely point out to you that it is not in the purview of the central bank to address the structural issues. While they will consider it, more of the work lies on fiscal policy, right? And right now, the goal is to stabilize prices. And prices, I mean inflation and the exchange rates. The central bank is doing what it can to ensure that the exchange rate is stabilized. We are seeing the naira appreciate. I think at the official market, the CBN's FM rate is around 1,490 thereabout, and the parallel market rate has also appreciated. So I think that we're at a point where these structural challenges that food production is facing, we need to see a lot more changes there, especially to address climate change impact. But what is more important is the fact that it does not rest on the side of the monetary policy, but it does rest on the side of fiscal policy. Now, having said that, there is room for more policy coordination, right? We are beginning to see that, but I believe that more of it will be very helpful to ensure that at least the central bank, the CBN, is moving in line with how changes are made on the structural side, on the fiscal side of things. But I will say that right now, looking at the numbers, there is still room, for the central bank to subliminally, reduce interest rates, to at least support and create some, to remove some of the burden, some of the cost burden on businesses. Remember, we've been on this tightening cycle for a very long time, right? And I think that right now, businesses, especially small-scale businesses that employ over 80% of Nigeria's population, they do need some breather. They need access to credit, and expensive credit only keeps prices high.
Right. So about what percentage point are you looking at, or what basis points are you looking at? I mean, he said 150 to 100. So what about you?
So I'm 25 to 75 basis points.
25 to 75. I'll go with 25. Right. I think to a very large extent, the conversation has sort of dwelt on domestic economic, activities and all of that. Now, let's look at, international or global economic developments. What's your take on that? How are they going to impact the MPC's decision?
Yeah, so if we look at it from the external side, like we've seen most majority of the advanced economies, they've been cutting rates probably throughout this year, so to say. A lot of the attention has been on the impact of tariff and also the oil price projection. Well, we're beginning to see a situation where most advanced economies are looking at this impact of hikes in tariff and how it's going to stifle down economic growth. So that's probably why we're seeing majority of these central banks, the Bank of England and most other ones, taking measured cuts into their policy rates. So we've noticed that over the past, let's say 2 months, majority of them have put growth concerns at the forefront of their decisions, keeping aside concerns around prices. So we're seeing a situation where majority of the central banks are easing interest rates. Just last week, we saw, like we rightly mentioned, the US Fed has also eased its own interest rates. And then if you bring that back home, the most important thing to look at is that the fact that from a global conditions, interest rates are coming down, and it also means that getting international financing opportunities, the cost of getting those, will I say, foreign or international borrowing from the international capital markets, they are also coming down. And I think that's also what the monetary policy would also be considering, because when interest rates come down globally, it also gives the incentives for the federal government, basically to look at assessing the international market for financing options. We know that in November, Nigeria has around a 1.1 billion euro bond maturity. So with global conditions, global monetary conditions sort of easing, it gives you the opportunity to know what, let's tap the international market for cheaper financing relative to, will I say, maybe a year or 2 years ago.
All right, thank you so much. Segun Shokwiton has also joined us now, Principal Partner, Woodridge and Scott Consulting. Thank you so much for joining us today, Mr. Shokwiton.
Good to see you, Perpetual.
Good to see you too.
It's a pleasure to be here.
Same here. It's a pleasure to have you. So tell us, what are you expecting from the MPC today?
I think if we look at all of the different factors that you have to consider in making these decisions, we probably will expect that there will be a very marginal drop in the NPR. We've had, I think it's 5 now, of this 6 consecutive months of disinflation. A lot of the other variables, whether you're talking about potential headwinds from the international space, whether you're talking about food inflation, and the fact that we are at the tail end of the harvest season and we have seen prices actually dropping. So this is not just prices not increasing at the same pace anymore. It's that prices are actually dropping, and some of those drops are significant. Looking at money supply and the fact that money supply is also, moderating. I think as far back as 2 months ago, there had been concerns about continued pressures from FAC allocations and all of that with regards to money supply, but that seems to have tapered off a bit, and we have seen, some sort of consistency in the reduction in money supply. So if you just take a look at all of those things, they are all pointing in one direction. We have been having a trade-off between keeping prices stable and curtailing growth to some degree with continuously high interest rates. But it would appear as though we've gotten now to the point where it would be a safe bet to cut rates slightly, marginally. So I wouldn't be particularly surprised if we get a 25 basis point reduction in rates. We've held now for think last 4 or 5 NPR meetings have been old decisions. And at some point, if you are no longer hiking, then you start holding. At some point, you will have to reduce so that we can begin to drive growth. Because at the end of the day, the growth is absolutely critical to economic progress. It's only when funds are available within the financial markets at prices or rates are affordable to producers of goods and services within the economy, you can then begin to see some inclusive growth in that economy. So I wouldn't be surprised to get a 25 basis point cut, maybe even slightly higher, maybe a 50 basis point cut, at least at the very least. I don't think that we're going to be seeing a whole decision this time around. All the factors point to the fact that the time for that cautious approach may have passed.
Well, when you look at the Bank of England example, I'm looking at the fact that they cut rates in August and then in September they decided to hold it. Hope we will not get into the Bank of England example by the time we decide to, cut rates at this point in time.
Yeah, I feel that the reason that the CBN has not cut rates up until now, there are some analysts, myself included, that have been kind of advocating for cuts as far back as 2 MPC meetings ago. And I know that's a bit, it's a bit expansive, if you like, or ambitious. But one of the reasons that the CBN governor has consistently given for not wanting to cut rates as at that time, 2 MPC meetings ago, and then the last MPC meeting, was the fact that there were still certain uncertainties in the international space, as well as locally. There are still some basic structural issues that are likely to put pressure from a cost-push side on inflation. And therefore, they applied the cautious approach. Reason being, they did not want to cut rates only to either hold or hike again. Right? So I think that we have passed that point with what's happened with the Bank of England. Let's not forget that in those economies, the lagging effect is not really quite as bad as what you have in Nigeria because of our structural inefficiencies. The pass-through effect, population, trickle-down effect, and all of that within our economy tends to happen much more slower because our economy is simply not efficient enough to transmit policy decisions into actual, onto the streets, if you like. So as a result of that, we want to be more careful, in environments like ours. Whatever happens, if the CBN, if the Bank of England changes their policy stance across 2 policy meetings, for example, the impact of that will be felt immediately. They can quickly course correct if they get it wrong. Okay. If you get it wrong here, you have to reverse yourself or go in the opposite direction, then the damage lasts for a bit longer because the pass-through effect is a bit slower here. So I think that risk of not wanting to change direction too suddenly or too quickly is the reason that they held so far. And I don't think we're likely to see what's happened with the Bank of England play out here.
All right, so to a very large extent, a lot of persons are expecting, a rate cut. So let's look at this now. Specifically, let's look at Nigeria's macroeconomic development. Inflation has slowed for 5 consecutive months, and then the oil sector actually drove Nigeria's GDP growth to a 4-year high of 4.23% in Q2. Now, specifically, the oil sector grew 20.46% year on year. When you compare that to 10.08% in 2024, and we also saw higher oil production cut non-oil share of GDP to 95.95 from 96.49 in real terms. Now, let's unpack all of this, especially starting with the GDP. What's your take, or what do you see in terms of ensuring that this, continues? And what do you think is even responsible in the first instance for this sort of improvement? Let me come to you, Dumebi. Let's start with you on this.
I'd say with starting with oil production, right? I would say we've seen a lot of government efforts towards ensuring that oil production is increased. We have seen deployment to reduce vandalism, to reduce theft. We've seen support towards the sector in terms of policy implementation. I will say that investments as well in the downstream oil sector have been significantly have been significantly improved, and that has also supported the growth of oil and also oil refining to eventually nudge, the contribution of oil to GDP. Right now, I think a very major milestone has been the Dangote refinery. We're also seeing the other modular refineries, the Kaduna, the Port Harcourt, Warri refineries, somewhat pick up refining activities, and we are seeing that oil production, at least as of July or August, I believe, we saw oil production, including condensates, reach about 1.7 million barrels per day, somewhat edging closer to the 2.06 million per day mark that the budget, is working towards. So I will say that all of those things combined have, propped up the contribution of that sector to GDP. The expectation is that these trends continue to at least ensure that the upstream and downstream sectors are, more competitive, are producing a lot more, and then of course increasing their contribution to GDP. So I'll say that's where we're seeing a lot more activities with oil production and oil refining. Then there are other aspects as well of the GDP numbers that I think are very interesting to look at, which is not really different from the way we've seen numbers, come up before. But again, I would say that we're seeing that very it's extremely important to just highlight it, and that's services growth, right? So the services sector has still remained, a very significant contributor to GDP growth. So from financial services to telecommunications, we're still seeing these sectors, prop up GDP. We're also seeing insurance, come up strong as well. And these are sectors that have benefited from changes in the regulatory landscape, from the bank recapitalization to the interest rate hike, also supporting their net interest margins, to the increase in tariffs for the telecommunications sector that has been able to allow them, increase prices and ensure, they're more productive. So I will say that these changes that we've seen are significantly supporting, GDP growth. I'll say trade as well is one sector that is also, beginning to come up again. And one thing that we have seen support that sector, both wholesale and retail trade, is the naira stability, right? So transactions, access to forex, importation, exportation, transactions are also getting better, and of course, supporting the growth in that sector.
Right, thank you so much, Dumebi Oluwole, lead economist. Cheers. Well, we'll go on a very short commercial break now, and when we come back, we'll continue the conversation. Stay with us. You're watching the 302nd MPC meeting. Stay with us. Glad to know you're still with us, and I have right here with me Dumebi Oluwole, lead economist. Cheers. Thank you so much for staying with us. Dr. Omobola Adu, macroeconomist, CSL Stockbrokers Limited. Thank you for staying with us. And of course, Segun Shopitson, principal partner, Woodridge and Scott Consulting. Thank you also for joining us.
Pleasure.
All right. Now, let me pose this particular one to you, Mr. Shopitson. I sort of feel it's important for us to bear in mind that, concerns over crude oil prices and lower than projected crude oil revenue with the potential impact on forex earnings may sort of pose risks to revenue generation and even foreign reserves accretion. So talk to us about how we can, hedge against this risk.
Well, I think the most first very critical thing that we can do, should be targeting to achieve, and that we have done, is to achieve some sort of stability, to take away the volatility in that space, in the foreign exchange market space. Because what volatility does is that it stifles productivity. People can't plan, and therefore they're more cautious. Investment flows are hampered, and so on and so forth. So with the stability in prices and exchange rates that we have seen, since the beginning of this year, maybe late last year, what that has resulted in is that transactions can flow smoothly without people being too scared, even though we still, it's early days, so to speak, with regards to this stability, the lack of volatility. We need to sustain that for much longer. Then we can begin to really reap the benefits. So that's the first thing. That's a good thing that we've done. But maybe we do need to go many steps further if we're to achieve the things that, for example, that the president has set out as targets for himself, the 7% GDP growth rate, $1 trillion economy, and all of that. Then I think we need to be talking far beyond price stability as our objective and as our driving the purpose in our economic management policies. For example, talking about the oil production issues and economy. So with regards to oil production, our ability to meet our OPEC quota on the one hand, but also to meet the demand from local refineries. We're expecting one or two other refineries to come on stream over the course of the next 2 years. How are we going to feed them? Where do they get their feedstock from? So we do need to continue to drive policy initiatives that will ramp up our production capacity significantly within the oil sector, so we can take full advantage of having that capacity locally on the one hand, and also so that it can drive, continue to drive our revenue generation capacity within the economy. Talking about accretion into the forex reserves, I think as important as that conversation is, there is no doubt, because it then provides a stable base to continue to manage our exchange rates and manage the market. But I think it's far more important that we are able to attract inflows into the market, liquidity into the forex market, rather than just the accretion. And there are so many policy initiatives that I think that the Central Bank of Nigeria can pursue to achieve this objective, to ensure that liquidity and supply is available within the market, which can then drive up the value of the naira. Driving up the value of the naira, for me, is a critical conversation because of the obvious impact that would have on economic progress and on price, not just disinflation, but actual price, reduction, significant reduction in the cost of living for Nigerians. We need to drive an increase in disposable income and purchasing power within the economy, so that consumption can be wrapped up significantly, which will then have the expected ripple effect on production, on investment, eventually leading to significant growth within the economy. So I think that there's still a lot of work to do with regards to or controlling all of these variables.
All right, Mr. Shokwiton, I reckon that the CBN governor has already started giving us the decision. So maybe we'll just quickly switch to that and then we'll come back.
All 12 members of the committee were in decisions of the MPC. The committee decided on 1, reduce the monetary policy rate MPR by 50 basis points to 70%. 2, adjust the standing facilities corridor around the MPR to plus 250 to minus 250 basis points. 3, adjust the cash reserve requirements, CRR, for commercial banks to 45%, while retaining that of merchant banks at 16%. Also, to introduce a 75% CRR on non-TSA public sector deposits. And 4, keep the liquidity ratio maintained at 30%. The committee's decision to lower the monetary policy rate was predicated on the sustained disinflation recorded in the past 5 months, projections of declining inflation for the rest of 2025, and the need to support economic recovery. The MPC also adjusted the standing facilities corridor to improve the efficiency of interbank markets and strengthen monetary policy transmission. The committee further introduced a 75% CRR on non-TSA public sector deposits for enhanced liquidity management. Considerations. The MPC expressed satisfaction with the prevailing macroeconomic stability, evidenced by the improvements in several indicators. These include the sustained improved output growth, stable exchange rates, and robust external reserves. Particularly noted the increased momentum of disinflation in August 2025, being the highest in the past 5 months. This deceleration, underpinned by monetary policy, exchange rate stability, increased capital inflows, and surplus current account balance, have helped to broadly anchor inflation expectations. Other factors that contributed to the deceleration include the continued moderation in the price of PMS and the notable increase in crude oil production. In the view of the committee, the stability in the macroeconomic environment offers some headroom to policy to support economic growth and development. Notwithstanding the consideration in inflation, the committee observed persistent buildup of excess liquidity in the banking system, resulting largely from fiscal releases emerging from improved revenues. Being mindful of the need to preserve the prevailing macroeconomic stability, the MPC noted the risks posed by the excess liquidity in the banking system. Members noted that effective functioning of the interbank market remains critical to enhance transmission of monetary policy. This, therefore, informed the decision to adjust the width of the standing facilities corridor to boost interbank market transactions and enhance the stability of the market. The committee acknowledged the continued stability of the foreign exchange market and its critical importance in achieving rapid disinflation, and therefore called on the bank to continue the implementation of policies that will further boost capital inflows and deepen foreign exchange policy. Financial sector, the MPC noted the continued resilience of the banking system, with most of the financial soundness indicators remaining within their respective potential benchmarks. Members also acknowledge the significant progress in capitalization exercise, fully met the new capital requirement. They therefore urge banks to continue the implementation of policies and initiatives that will ensure the successful completion of the ongoing recapitalization exercise. The committee further noted the successful termination of forbearance measures and waivers considered public law, which has helped to promote transparency, risk management, and long-term financial stability in the banking system. The MPC reassured the public that the impact of the removal of forbearance is transitory and does not pose any threat to the soundness and stability of the banking system. Price and other domestic developments. Headline inflation year-on-year moderated further to 20.12% in August 2025 from 21.88% in July, a decline in both food and core inflation. On a month-on-month basis, headline inflation also decreased to 0.74% in August 2025 and 1.99% in the preceding month. Similarly, core inflation year-on-year eased to 20.33% in August 2025 from 21.33% in July due to the slowdown in the cost of services, housing and utilities, as well as transport and logistics. Food inflation year-on-year also moderated to 21.87% in August 2025 from 22.71% in July, attributed to the decline in the price of staples, especially rice, uniform, maize, and millet. On output, the recently released GDP for the second quarter of 2025 shows the sustained resilience of the Nigerian economy, with a real growth rate of 4.23% year-on-year compared to 3.13% in the first quarter of 2025. The committee particularly noted the significant improvement in the performance of the oil sector, which grew by 20.46% compared to 1.87% in the preceding quarter, a positive development that is expected to further bolster foreign exchange reserves and sustain stability in the foreign exchange market. In this regard, the committee commended the efforts of the federal government and called for continued vigilance to strengthen the momentum of security across the country in order to increase oil output and food production. Gross gross external reserve remained robust at $43.05 billion as at September 11, 2025, compared with $40.51 billion at the end of July 2025, with an import cover of 8.28 months. Similarly, the second quarter 2025 current account balance recorded a significant surplus of $5.28 billion compared with $2.85 billion first quarter of 2025. Global developments. Available projections indicate that global output recovery is expected to improve on the back of favorable trade negotiations and monetary policy easing, particularly in the advanced economies. However, persistent geographical tensions and increasing uncertainty disrupt global supply chain and dampen the output. Global inflation is projected to sustain its deceleration, albeit at a slower pace due to the impact of trade tariffs and other structural factors. This trajectory has necessitated a cautious and data-dependent approach to monetary policy easing by central banks, especially in emerging markets and developing economies. Outlook. Staff projections suggest a sustained disinflation over the coming months, driven by the lagged effect of previous rate hikes, continued stability in the foreign exchange market, and decline in the price of units. Furthermore, the onset of the harvest season is expected to increase local food supplies, moderate food prices, and contribute to the overall decline in inflation. In its commitment to the core mandate of price stability, the committee will remain proactive through a data-driven policy response. The next meeting of the committee is scheduled for Monday, 24th and Tuesday, 25th November 2025. Thank you.
Thank you. That was communique number 159, presented by the chairman of the MPC and the governor of the Central Bank of Nigeria, Mr. Olayemi Cardoso. Now take some questions. First, please state your name, your region, and service, and as usual, your entitled questions. Thank you.
Mr. Chairman, esteemed members of the MPC, name is Lion Supreme, Government Level. Mr. Governor, sir, very recently the Central Bank compared a new
Glad to know you're still with us. And right there, we had the governor of the Central Bank of Nigeria, and of course, the chairman of the Monetary Policy Committee, telling us the decisions of the bank. And just as my guests have projected, they projected 50 basis points. I mean, you projected 50 to 100, right? All right. So, I mean, you tried. And I know you maybe projected 25 to 75. So it's within range. And we also had Mr. Shopito also projecting a rate cut. So a win for all of you. Okay, so away from that, I mean, the CBN introduced something, and that's the 75% CRR on TSA. Did you see that coming out? What does that even mean, you know, compared to what we're normally used to?
I mean, I didn't see that coming, to be very honest. It's a very interesting development, but I guess what this just means is, to some extent, trying to mop up some liquidity, obviously trying to manage liquidity across that system. Because when you really think about it, what exactly is a CRR? What exactly is CRR? And CRR is just a mandatory percentage that banks or financial institutions or financing institutions, right, should keep with the central bank to somewhat manage. It's a monetary policy tool that the central bank uses to manage, you know, liquidity within the system. And so if they are doing this, it means that there's some level of increased liquidity within that space that needs to be managed. And if that is the case, it obviously points to the central bank trying to adjust their tools and ensure that at each point, all forms of money supply or all forms of credit thereabout are ensuring that their goal of price stability or even price reduction is achieved. And when you look at this happening side by side, the reduction in CRR with commercial banks, what that simply tells us is that there's some level of liquidity within that system that the central bank is trying to, you know, adjust for or account for and reduce, while ensuring that lending is increasing to business owners. Because with the reduction in CRR, what that simply CRR for commercial banks now, and what that means is that banks now have additional cash available to them, you know, to give out, especially as loans to businesses. And what that looks like is a possible reduction, right, in lending rates, which will be quite marginal, because the reduction in the MPR is marginal, and the reduction in the CR is also somewhat marginal. So I think that's my take on it.
All right. Okay. So let me have your thoughts here. I mean, you're right here with me in the studio. So what do you make of? Let me just put it open for you. What do you make of the decisions, all of them?
Yeah, so I think just going back to what maybe said at the start of this broadcast, right, and the fact that CBN is more likely to be cautious in the way they're going to reduce interest rates. And I think with the introduction of the 75% CRR on public sector funds, it highlights that cautious stance that the Monetary Policy Committee is taking in their decisions. Like we said at the start of the meeting, general expectation was that the Monetary Policy Committee, they were going to cut interest rates. The 50 basis point reduction is in line with our expectation, just taking into consideration what we've been seeing in the domestic and the external environment. So we're going to have to see a situation where the general interest rates in the market are going to be repricing towards this new interest rate level. The other maybe decision to highlight was the move to adjust the asymmetric corridor.
I think we were talking about it.
So like I mentioned at the start of this meeting, that's something that they'll probably have to do just to ensure that liquidity in the interbank market is priced properly. Because if you had a situation where they didn't adjust that, it would make sense maybe for monetary authorities, for the likes of financial institutions and banks to just ignore government securities and then playing around that standing deposit facility. But with the decision to move these rates lower, it's going to have a situation where market interest rates are going to be repriced accordingly.
All right, that's interesting. Mr. Shopito, let me have your thoughts finally on that. Okay, I guess we have an issue connecting with him right there. Okay, so apart from that, maybe I didn't quite, speak to you about the other ones. Let me get your thoughts on the asymmetric corridor, which is now being adjusted to plus 250 minus 250, and then we also have that one about, let me get your thoughts on that one first.
Yeah, I think the first point of action is even understanding what the asymmetric corridor is, and it's just simply basis points around the MPR within which commercial banks or banks really can borrow from the CBN or even deposit from the CBN. I think at the last point where before now, where the asymmetric corridor was, I think plus 500 basis points over minus 100 basis points. I think the incentive there was to encourage banks to actually deposit with the central bank so that they're able to get more interest rates. And that was in a bid to, it was in alignment with its tightening stance to curb, money supply, curb interbank liquidity, and just all round reduce inflation. So right now that they have adjusted it lower, what this just means is that banks have matching, they have matching decisions now. They have matching options to either, invest. To either put funds with the deposit funds with the central bank.
Thank you so much for your thoughts on that one.